To welcome you to our final installment of our Everyday Money Skills community series led by Michele Eden Montas. This is the sixth program that we've done in this series. Thank you all. I know some of you have managed to come to quite a few, if not all of them. So thank you for taking the time and making the time. And I really look forward to our discussion tonight. This is going to be taxes, retirement, and investing. So I'm sure we have a lot to cover, so let's just get into it, Michele.
Awesome. Well, thank you everyone so much for being here and for spending time over these past several weeks. I'm personally most excited about tonight's session because it's what I do for a living, investing. And so I'm really excited to see, where our discussions take us, questions, etc. Um, so let's go to slide 2. Thank you, Lizzie. I feel like we've spent a lot of time over the past several weeks talking about more immediate financial survival, things like budgeting, dealing with irregular income, managing debt, building credit, emergency planning, and finding local resources. And these are all foundational skills. But tonight we're going to shift into longer term financial planning. And so I want to frame this carefully because investing often feels intimidating. And for many people, especially women, investing can feel like something only wealthy people do, something really complicated, something risky, or something that they feel they should already understand but don't, and it's thus overwhelming. But the reality is, like many of the things we've covered, most people were never taught this. Schools don't teach investing, families often don't talk about it. Um, and sometimes the media can make it seem dramatic and chaotic. But long-term investing is usually surprisingly simple and boring. And it's less about brilliance and picking, that one right stock. And it's more about consistency, patience, avoiding major mistakes, and then giving money. And so we're going to talk about all things. But I want to emphasize that this is not about becoming rich overnight, meme stock speculation, none of that kind of investing. So it's about understanding systems well enough to reduce fear, make more build. I ask, oh, perfect. Thank you. So let's move to the third slide, a slide I have every time, and I think everyone here is a veteran. But as always, I encourage questions anytime, just going off mute or putting one in the chat. And of course, it's also okay to just listen along. So let's go to slide 4, where we're going to talk a little bit about taxes. The bulk of tonight will be about investing. But I wanted to start with taxes because taxes quietly shape almost every financial decision that we make. And a lot of people think refunds are free money from the government, but usually a refund simply means that too much money was withheld from your paycheck during the year. And so think of withholding like an estimate. Your employer estimates taxes from each paycheck and then sends money to the IRS throughout the year. And then during tax season, everything gets reconciled. And so some people intentionally prefer larger refunds because it feels like forced savings. And then other people prefer larger paychecks throughout the year because you want that cash flow monthly. And neither approach is automatically right or wrong, but understanding refunds matters because many people emotionally treat refunds differently than regular income because it can almost feel like found money. But I want to introduce the idea of using refunds for paying debt, emergency savings, car repairs, catching up on bills, and investing. So a lot of the things we've talked about in the past and are going to talk about tonight. And to me, refunds can become an opportunity to start building that long-term financial stability. So let's go to the next slide where we'll touch on tax credits. And a major reason that filing taxes matters is because of tax credits. because they can really increase refunds for households. So the earned income tax credit, for example, was specifically designed to support lower and moderate income workers, and many people qualify for it without necessarily realizing that they do. And some people might assume I don't even make enough money to file, but filing may actually be how someone accesses money that they're entitled to receive. So I highly encourage filing. And importantly, tax refunds can become powerful financial tools. And so a strategy that certain financial advisors could recommend is before tax season even arrives, think intentionally about your refund and what would help your future self the most. So possibilities like paying down high interest debt, building emergency savings, starting retirement savings. And of course, I recognize tax season just passed, but things to think about going forward. So let's go to slide 6, and we're going to start talking about investing. And so, why does investing really even matter? And one of the big reasons it matters is because of inflation. And inflation just means prices increasing over time. And everyone here has experienced this personally at the grocery store, at the gas station, and things cost dramatically more than they did even 5, 10 years ago. And it creates a challenge because if money sits still forever, it can gradually lose purchasing power. Purchasing power just being how much you are able to buy with that same amount of money. And that's one reason that investing exists and is important, because people invest because they want money to have the opportunity to grow over time instead of standing still. And I want to be careful here. Investing always involves some risk, and we're going to talk about that risk. Nothing is guaranteed. But when you look at the historical data over long periods of time, investing has been one of the primary ways that ordinary people build long-term financial security. And I think it matters especially for women because women often live longer. They can spend more years caregiving. They can sometimes earn less over their lifetimes relative to their male counterparts. And women can be more likely to experience financial vulnerability later in life. All reasons that investing and at least keeping pace with purchasing power is important. So let's go to slide 7. What is investing? Because I think the media, the internet has distorted how people think about investing. Can seem risky, emotional, fast-paced. People might see cryptocurrency, day trading, people claiming they turned $500 into $1 million, and none of that is what we're talking about. And it's not what constitutes healthy long-term investing. And so long-term investing is really about being patient, diversified, ultimately boring, and consistent. And boring is good because the goal is generally not how do I get rich fast and have a bunch of money tomorrow, but more so how do I build financial stability over time? And that's a very different mindset. So let's go to slide 8. Oh, Lizzie, can we move? Oh, there we go. Perfect. Thank you. So what is a stock? It is a bedrock of a lot of investing. And at its core, it is you buying a tiny piece of a company. Companies that affect our everyday, like Walmart, Google, Coca-Cola. And if a company becomes more profitable and valuable over time, your investment may grow in line with that. But stock prices move up and down constantly. And it's important to know that investing in stocks involves risk, and the value can decline, sometimes significantly. And that's why an understanding of that risk and a long-term perspective matters. Because while stocks may go up and down in the short term, when you look at long-term curves of diversified stock ownership, they generally increase over long periods of time. And so when people invest in stocks, there are two primary ways that they're making money. The first is stock appreciation, meaning you buy a share of a stock at one price and those shares become more valuable because the company is doing well. And then the second is dividends. And I actually think that's a really nice way to give yourself some cash flow in the stock market. Dividends are cash that the company is distributing to its shareholders. So you might expect a quarterly dividend payment simply for being an owner. And some stocks have no dividends, some have very small ones, and then some can have dividends that are quite meaningful, say a 7% dividend that can, you know, you can feel it in your wallet. Now, many retirement investors reinvest dividends automatically. I personally do, meaning those dividends buy additional shares. And that's another way, and we're going to talk about it again today, but that compound interest is doing its magic. Okay, let's go to slide 9, where I will introduce the concept of bonds because stocks and bonds are two foundational investment categories. And as retail investors, the two primary things we would be investing in. So while stocks represent ownership in companies, bonds are sort of the corollary to that because they are loans to governments or companies. Now, historically, stocks have generally offered higher long-term growth potential, but with that growth also typically comes more risk. So they will fluctuate more. And bonds work differently. When you buy a bond, you're essentially lending money to a corporation, a municipality, a government, and in return, that bond pays interest. So it's much more like a contract, and you know how much money you're expecting back versus a stock. And so bonds are generally considered steadier than stocks, although they still carry risks. And it's important to understand the underlying bond. Say it's a bond with the US government, that will have less risk than a bond with, an early stage company. Now, many retirement portfolios include both stocks and bonds. Stocks for growth and then bonds for stability. And then as people age, they change their portfolio allocation. So when you're younger, you might have more exposure to stocks to take advantage of that growth potential while you have that ability to withstand volatility. But then when you get closer to the age where you need that money, you will focus more on stability. So let's go to slide 10. And this is a graph that I have introduced before, but it's probably the most important investing concept that exists, and that is compound interest. And so for those who maybe weren't at the session or want a repeat of what we talked about, this graph is showing us starting with $500 and adding $300 a year, so $25 a month. And so in year 1, you see that green, mostly your contributions. Year 2, still mostly your contributions. But then over time, you see that yellow piece get bigger and bigger, and that's the interest. And after 20 years, you have deposited $6,000, but you have made nearly $4,000 in interest. And so we can see that time matters enormously because the more time you have, the more your profits are being reinvested. And not only are you making money on the money you put aside, but the money that grew yesterday is continuing to grow. And so the point of this slide is really investing is not predicting the market, timing the market perfectly. It's really giving yourself the time to allow growth to happen. And so at first, growth feels tiny, and that is frustrating. But over time, growth begins accelerating because your money is earning money on itself. And so while those early years can feel like the needle isn't really moving, it's those outer years that are what make the difference. I'll pause here because I've talked about a lot of different concepts, and I want to see if there are any questions on different investing frameworks, compound interests, anything that I've said. Okay, I'm not seeing any questions, but I know it can be a lot of different forms of information. So if there are questions at any point, please raise your hands. But for now, we can go to slide 11. And this is the slide that is the most practical one of the entire evening. Many people might assume that investing means picking winning stocks or predicting specific markets or outsmarting everyone else. But the reality is, many professional investors fail to consistently beat the market over long periods of time. Like, let that sink in. People who spend their whole days doing this rarely beat the market. And so that's really important to understand because Wall Street is employing economists, analysts, they buy tons of data, have huge research teams, and they're still struggling to outperform simple index funds after fees. And so that's why a lot of experts recommend index funds for retail investors being you and me investing in our retirement accounts, or really any account. And what is an index fund? It simply buys many companies at once. So instead of trying to guess, oh, I see a hand up from Sasha. Go ahead.
Yeah, hi Michelle. I'm just wondering, I mean, I've heard that before, that statement. And so then why does the financial services industry exist? Like, why isn't everyone just invested in index funds? You know what I
It's
mean?
a great question. And I think a very fair one where you often see large clients paying for not the promise, but the hope of beating the market, and it rarely happens. I would say it exists because it can happen, and it's rare. It's very sought after, and when it does happen, it can make meaningful amounts of money. So you have a lot of people chasing that rare bird. Second, the financial services market can offer exposure to more esoteric investments that you wouldn't necessarily be able to get in your run-of-the-mill index fund. That said, those often have higher risk, are really important to understand the details around, and are also providing something for professional portfolios that you and I don't necessarily need. Like, oh, they want exposure to, Brazilian energy, something specific like that, that I personally don't need in my retirement account. But it is a great question because oftentimes the goal that they set out to achieve, they fail at.
Great, thank you.
Mhm. So, what is an index fund? It's just investing in a lot of companies at once. And so instead of trying to pick one horse that you think will succeed above the rest, and that is exceedingly difficult to do, you own tiny pieces of hundreds or thousands of companies together. And there are a lot of benefits to doing this. One, diversification. So if one company goes up, another one goes down, you are sort of in the middle of that instead of just having the one that went down. Simplicity, not having to do a ton of research into individual stocks. Lower fees, these tend to be very inexpensive. And then reduce pressure to constantly make decisions. You can buy an index fund and hold it for the long term. And that's a reason index investing has become so popular. So let's go to slide 12. What is diversification? If all your money depends on one investment succeeding, that creates an inordinate amount of risk. Because yes, a company will do well or go down based on its own performance, but it's also exposed to general market factors. And so, given those factors and the company itself, it's really important to have different factors in your portfolio. And diversification helps reduce the risk by spreading investments across many companies, industries, sectors, so that when one doesn't do well, another one hopefully can offset that. So let's go to the next slide. And here I'm going to talk about the emotional side of investing, because I'm sure those of us who have investment accounts, whether they're brokerage, retirement, anything, when the market is going down and you check that number, you know, your heart goes fast and you think, oh, should I pull out? Like, what do I do? Maybe I don't understand everything that's going on here. What's the best way to proceed? And so markets will absolutely go down sometimes. And that's a guarantee. And when they do, the headlines can become quite scary. But market declines are normal. And historically, markets have experienced recessions, wars, COVID, political crises, you name it, it has happened. And so if you, like me, can start to feel concerned when the market goes down, something that I like to do is look at long-term stock graphs where you'll see 1929 and 2008 and COVID and all of these major world events. But then over the long term, it's typically going up. So let's move to slide 14. And this is sort of a continuation of the last slide to talk about that emotional side of investing and then how to catch ourselves when that is happening. Because one of the biggest investing challenges is emotional behavior and acting on it. Because people often feel confident when markets rise, but then when markets fall, fear increases dramatically. And many people panic sell after prices already dropped, but then the markets eventually recover without them. And so, of course, if you need the money for a specific reason, or you really feel you need to get out of the market, of course, there are going to be personal decisions here. But I would caution against when the market takes a dive, thinking, oh no, it's going to continue taking a dive forever. I have to get out. And instead holding the line and leaving your money in there and letting it, you know, recover and then hopefully grow over the long term. Let's go to slide 15. And so this is a strategy I personally use that I really like because it takes some of the panic out of it for me and my desire to, you know, do things perfectly. And that's never going to happen in investing. And it's called dollar cost averaging. And it means investing a fixed amount regularly over time. So for example, every paycheck, every month, every week, whatever cadence you might find works for yourself, you are putting money into the market. Sometimes the market is higher, sometimes the market is lower, but this strategy reduces pressure to perfectly time the market. I personally have been in situations where I feel like the market has been rising for a long period of time. Is it too hot? I think it's going to go down. I'm not going to invest. And then the market keeps going up. And it's impossible to time the market. So instead of doing that, I just invest sort of the same amount every 2 weeks when I get my paycheck. And data does show that this strategy typically does well over the long term relative to trying to time the market. So let's go to the next slide and get into the details of retirement accounts. So why do they exist? They exist because the government gives certain tax advantages to encourage long-term investing and saving. And those tax advantages can become extremely valuable, particularly over long periods of time. Now, very importantly, there is no universally perfect or better retirement account. Different accounts have different tax treatments, different rules, different advantages, and different drawbacks. And eventually, a lot of people end up having a combination of accounts to be able to benefit from the diversity of positives. So inside these accounts, people may own index funds, target date funds, bonds, stocks, mutual funds, and we'll get into these things in more detail. But first, let's go to slide 17, the big three retirement accounts. So there are three types of retirement accounts that most people are likely to encounter. 401k is usually offered through an employer, and a 403b is very similar. It's just common in nonprofits, schools, and public sector jobs. But in terms of tax treatment, they are the same. Then traditional IRAs and Roth IRAs are individual accounts that people generally open on their own, not through an employer. And the biggest difference between these accounts is usually when the taxes happen. So if we go to slide 11, we'll first go into detail on traditional IRAs. So with a traditional IRA, contributions can reduce your taxable income today. So for example, if someone contributes into a traditional IRA, they may pay less in taxes this year than they otherwise would. Then the investments grow over time inside the account. But later, during retirement, when you're making withdrawals, taxes are generally paid on that money. So traditional IRAs are often described as pay taxes later. So why would someone want to do this? One reason is they expect to be in a lower tax bracket in retirement than they are now and want to take advantage of that mismatch. Another reason is the upfront tax deduction today can help your financial situation right now. But there are trade-offs. Eventually, taxes are generally due on withdrawals. So if we go to slide 19, we'll talk about the corollary, a Roth IRA, which works differently. So with a Roth IRA, you contribute money that has already been taxed. So there's generally no upfront tax deduction today. But the major advantage is this. Qualified withdrawals later in retirement may be completely tax-free. And that can become incredibly powerful over long periods because not only the original contributions, but potentially decades of growth may eventually come out tax-free. And so why would someone opt for a Roth IRA? They may expect tax rates or their income to be higher later. Another reason is workers may have decades for investments to grow tax-free, and they want to take advantage of that. And then psychologically, some people like the idea of knowing, I already paid taxes on that money, like that's done. But again, there's no universally correct answer. Both accounts can be valuable. And sometimes both can be good. I personally have both because I don't know how my tax bracket is going to compare when I am in retirement versus today. And so I like to, again, when we were talking about stocks and bonds, sort of infuse diversification into my retirement planning. So let's go to slide 20 to talk about employer plans. So 401ks and 403bs. One major advantage is automation. So money can automatically come out of paychecks before you even see it. And psychologically, that can be very helpful because it helps us stay consistent. And then another big advantage is employer matching if your employer offers that. So 3%, 5%, some portion of employee contributions. And I would say if that is something that you have access to and you feel you are able to save for retirement, it is essentially free money. And so if you feel you're in a position to be putting money away for retirement, highly recommend taking advantage of any employer matching that you may have access to. Now, there can be some drawbacks with employer plans. First, investment options may be limited. They often, give you a relatively short roster of things you can invest in. Fees do vary. You always want to compare fees with anything you're investing in because you may be getting essentially the same product in two places, but paying different fees. And some plans are just better overall than others. But I would say employer matching can be very valuable. So let's go to the next slide to talk about what should actually be in your retirement account. And so before we even get there, one mistake that I have seen people make is that they open a retirement account and they put money into it, feeling like they're contributing to their long-term financial plan, but then they don't actually make an investment choice in the account and it just sits in cash. And so after opening an account, the next question becomes, what should actually be inside it? Where should I put the money? And this is where a lot of experts would recommend simple, diversified investments. And so a couple examples. Broad stock market index funds, the S&P 500 index. The S&P is an index that tracks the 500 largest companies in the US. So companies like Google, Microsoft are at the top. They are the biggest ones. Total market index funds, bond index funds, or target date funds. And again, many professionals believe most ordinary retail investors are better served by low fees, diversification, and then having that long-term consistency rather than trying to time the market. And on the next slide, I'm going to go into detail on target date funds because they have become quite popular since they simplify investing. So let's go to slide 22. So what is a target date fund? Essentially, you choose a fund based approximately on when you expect to retire. So someone retiring in 2050 would choose a 2050 target date fund. And earlier in life, the fund typically holds more stocks because you're able to take advantage of the potential higher growth, but then also withstand the volatility that usually comes with stocks. And then as retirement approaches, the fund gradually increases bonds and stability, so also cash automatically. And a lot of people like target date funds because they simplify decisions, they provide that diversification we were talking about, and they reduce the pressure to constantly rebalance investments yourself. I personally love investing. I love going into my account and seeing what I own and changing things around. But a lot of people don't like to do that. And they want to make a choice once and then, let it be. And so target date funds are a really good thing for people who want to invest for the long term, but don't necessarily want a very hands-on approach. So let's go to slide 23 to talk about HSAs or health savings accounts. I think they're one of the most underappreciated financial tools that exist. And now they are relatively specific in that they're only available if someone has a qualifying high deductible health plan. So not everyone is eligible. But for eligible households, HSAs can be really powerful because they have what's called triple tax advantages. And that's pretty unique financially. I personally can't think of another vehicle that has triple tax advantages. So the first advantage is that contributions reduce your taxable income today. So that means money going into the HSA lowers taxes today, similar to some retirement accounts. The second advantage is investments inside the HSA can usually grow tax-free over time. And so if someone invests the money in their HSA, and I would recommend investing it very similarly to how you would invest your retirement account, those earnings may compound without paying taxes today or tomorrow. And then the third advantage is that qualified withdrawals for medical expenses are also tax-free. And so if you think about three hits on taxes, tax deduction going in, tax-free growth, and then tax-free medical withdrawals later, that's really powerful. And some people use an HSA like a checking account for doctor's visits and prescriptions. But increasingly, and this is how I use my HSA, I use it as a long-term investment vehicle so that it can compound over time. And then I keep my medical receipts so that in a couple decades, hopefully, I've been able to benefit from compound growth and I pay myself back for all of the expenses that I paid out of pocket for in the past. Now, let's move to slide 24. And to talk about sort of a different way of thinking about investing versus what people might typically portray. And I'd say that starting small is completely fine. And it should never be a sense of, I'm not putting a lot of money away. Like, what's the point? This is for large sums of money. Not at all. Consistency is a huge component of investing and then taking advantage of time. So I would say if you can put away a very small sum every week or automize investing from your paycheck, use a tax refund to kickstart a brokerage account, I think that's a wonderful place to start. And so before we get to the last slide, I want to pause again to see if there are any questions, because I know I've covered a lot of different ways of investing, maybe things you are already doing, things that you heard of for the first time tonight. And I spend a lot of my time thinking about investing. So any questions you might have or things? Yes, Sasha.
Hi, sorry, let me turn this. I'm so sorry. I was helping my daughter do some math homework, so I might have missed this. But I know you probably didn't recommend any certain funds, but I was wondering how you feel about Vanguard. And I don't know if you can answer that question or not. But
Yeah,
yeah.
I think for retail investors, as we all are, Vanguard, Fidelity are all good providers because they typically give a lot of investment options at low fees. And so when we're not trying to time the market, we're just trying to get exposure to a lot of companies to give ourselves that diversification. You always want low fees because if you think about it, what service are they really providing you? Not that much of a service. So you shouldn't be paying for a service. And so Vanguard is an example of a provider that does have low fees. Fidelity is another one. I personally use Fidelity just because that's my employer's retirement plan. And then I have other stuff with Fidelity as a result. But I think those two providers are good. Always look at the management fees, is what they call them. They should be exceedingly low. And if they're not, shop around. Like you're never forced into one specific fund. If you see Vanguard has an S&P 500 index, the other players do too. Like these are so readily available. So I would play the fee game and then also think about the user experience. I think Vanguard and Fidelity are very easy to use. Um, Also, make sure you're never paying fees on individual trades. Sometimes people try to, make you pay a couple dollars per trade, and the market has gotten too competitive for that to be the model anymore. So I would say look out for that. What is considered to be a low management fee? I would say in the like decimals percent. So like 0.0 something, very low. Unless you have a financial advisor who's, working with you on the day to day, I'd expect something more like 1%. But for an index fund that you are buying online, 0.0 something percent.
And Michelle, just my last question.
Mm-hmm.
Um, how do you feel about target retirement funds? Like, so oftentimes I've seen on Vanguard that they'll say, oh, when you're retiring this year, you should, it's kind of like we've been investing in 529s for our kids for college. And I understand this. I don't want to like go into, I know this is a beginner experience, but I just have a quick question.
Oh,
Um,
go.
and so the 529s, like our daughter is going to college in 2030. And so the fund has a target date of 2030 so that when she graduates, it should mostly be in cash. And I've noticed that Vanguard has the same thing for retirement. So like, I'm 50, so that the target retirement would be 15 or 20 years from now. I'm assuming it slowly moves to a more conservative, meaning like cash or more bonds. I'm wondering how you feel about those target date funds.
Yeah. I personally do not use a target date fund because I find them too conservative for my purposes. But again, I'm talking about myself. I have many years until I retire. I have 100% equity exposure, so only stocks, because I want that exposure to growth potential and I have the time to withstand the ups and downs. So at this stage in my life, I don't want bonds in my portfolio. That said, when I grow older, I will definitely be moving and having more bonds and then eventually cash. Now, I love investing and I love checking my account and rebalancing, selling things, buying things. A lot of people don't like to do that. And so if you don't like to do that, I think target date funds are great and they are quite conservative. And so it is rare for a person to see a target date fund and think, "Oh, that's like riskier than I wanted." I'd say typically. Of course, your disposition matters. If you are a really conservative person and you hate the idea of losing money in the stock market, that's so valid and you should stick with that. Like never let someone push you into a risk category you're not comfortable with. So I'd say generally target date funds are helpful for those who want a hands-off approach to investing. They are quite conservative. And so for someone going to college in 2030, of course, you cannot afford to have that be only in stocks because we never know what is going to happen. But if you look at the underlying asset allocation and it's, you know, say vast majority bonds and cash, that's not really going to grow. So you need to ask yourself what you're comfortable with risk profile wise, and then what return you're expecting.
Great. That's really helpful. Thank you so much.
Mhm. Any other questions about anything I've touched on or something I haven't touched on that you're like, wait, we haven't talked about this? How do you open an investment account? Just get a Vanguard or Fidelity app or something like that. That's a great question. I would say if you're opening an account, do it on the computer, not your phone. Just because there's a lot of functionality in these investment platforms that you can't see on your phone. I have the apps on my phone and You're able to do things that you can see your positions, you can trade, but the computer version is much more comprehensive. And I feel like with investing, you always want it to be more comprehensive. So you go to, fidelity.com or vanguard.com, and it's quite simple to open an account. They walk you through the steps. They will ask for, pretty personal information. So, keep that in mind. They'll probably ask for your social security number because they need to be able to trace who money is tied to. But yes, you go to one of those two or another provider if you so choose and create the account that you are looking for. And that can be multiple accounts. So a choice is, what kind of retirement account do you want in terms of, taxes today, taxes later? Is it a brokerage account? Is it a 529? Is it an HSA? Both of these providers do all of the above. I would say it's nice to have everything in one place. You very much don't have to, but I have several accounts with Fidelity, and if they were elsewhere and sort of some in Fidelity, some in Vanguard, it'd be harder to manage. I like seeing everything in one place. So that's another thing to potentially think about. And then they'll have you hook up your Fidelity account to your bank account, like your Chase or whoever you bank with, so that you can wire money. So that's another thing to keep in mind. I'm personally totally fine with this. I think they're secure, but I do know some people are uncomfortable sharing, their bank information online. Can I get 401ks through them, or does that have to come from my employer? Great question. So a 401k/403b comes from an employer. That said, you can open a traditional IRA or a Roth IRA right now. And as we talked about before, they do have different tax timing. So think about what makes sense for you. If you do have an employer that offers a 401k, I would take advantage of that because you might have employer matching. But to do that, that has to happen through your employer. You can't go on Fidelity and say, like, where's my employer's 401k? That all happens through the employer. But yes, you can open a traditional IRA or a Roth IRA anytime by yourself. Any other questions about types of accounts? I've never invested before and have no idea where to start. Like, what do I buy? That kind of thing. What do you consider to be a good employer match percentage? It's a great question. I've seen it range materially. I've seen everything as low as 1% to 15%, 1-5. 15 is rare. Most people do not have that. So I would say more typical would be 3 to 5, 3 to 6 is an average that I would expect. And then sometimes that's subject to vesting. So if you don't stay at the company for X number of years, you forfeit X amount of match, but 3 to 6. How do you decide what amount to save for retirement per month, like a percentage? Also a great question. I think about it backwards, and I think everyone should have a retirement number in their mind. Like, when I retire, I want X dollars. And of course, that number is hard to get to on its own. You have to consider, how long you think you might live, how much money it takes for you to live, and then incorporate inflation. Always remember to do that, because when I'm retired, things will cost different amounts versus what they cost today. But ultimately, you start with a number when you're planning on retiring that feels like that's a really comfortable number for me. And I always try to sort of pad that number and not make it too low, because it's always better to sort of have a conservative lens built into how much money you might need in retirement. So I start from that number and work backwards. And so I essentially, it's called present valuing, but you move the cash flows back to your age today. And so the way you can do that in the future value calculator that I shared in another session. If you don't know what I'm talking about, just type like retirement calculator online. There's so many really good templates that, you put in number of years until retirement, amount of money that you want at age X when you retire, your return expectations. That's a big one. And then it brings it back to your age today and thus how much to save each month. You don't want to guess this kind of thing. You don't want to say, oh, this amount of money feels good to be saving. You want it to be quantified. Another thing to think about is the government limits. So government limits, I think this year for 401ks are 24,500. So obviously you can't go above that, but you can get up to that amount in tax advantages. So that's another sort of quantified framework to think about it. But yes, I would work backwards. And then in terms of the return expectation, you might be like, well, what number do I put into the calculator? Always be conservative because you don't want to put in a number that feels lofty and then the stock market does not hit that number. I would put in 6 or 5%, depending on how you invest. If you're a very conservative investor, less than that. If you're only doing bonds, it's less than that. But if you're having a stock portfolio with some bonds, I would say 5 to 6% is a fair expectation. Hopefully, it's higher than that over the long term. It has averaged at about 7%, the equity markets over long periods of time. So you always want to go a little bit below that so you're not then, blindsided with a bad surprise. There was another question. How long are receipts valid for an HSA? And do you have to choose how HSA money is invested? Both great questions. These are great questions. HSAs, it's like amazing that the government allows this. I could go to the doctor today, save the receipt, submit that receipt in 30 years, and pay myself back. There is no expiration. You just have to save the receipt. So you need to be organized about it. But if you have access to an HSA, I highly recommend it because you get the triple tax advantages and you essentially can create sort of a retirement fund just for medical expenses. And as we all know, those are very high. So I actually pay for everything out of pocket, even though I have an HSA. And then I save all the receipts and I plan to pay myself back in like 40 years because I'll have benefited from that compound growth. I think there was a second question. Yes. Do you choose how HSA money is invested? Yes. And that goes to something I was saying before where, people set up accounts and think it is then set up and good. And that's only step one. The very important step two is choosing how to invest the HSA. So personally, I have a lot of it in the S&P 500. Just track the 500 largest US companies over the long term. If you need that money tomorrow, don't do that. You might have a more, stock bond lens where, say, 60% stocks, 40% bonds. That's a very popular framework. So again, think about when you need the money. That will inform how you invest it. Can a self-employed person or small business set up an HSA? That is a great question that I don't totally know the answer to. I know you have to have a high deductible health plan. That is a requirement. Beyond that, does it have to come from an employer? I don't know, and I will find out. These are really great questions. Have I gotten all of them? I think so. Okay. Any other questions?
Yeah, I've got a question, Michelle. So I have like some random bits and pieces of retirement money from past jobs when I used to work for Massachusetts as a librarian. And I have been wondering, I guess, like what the best thing to do, like how should I put them all in one? They're sort of just sitting there, they're not making a lot more, I think, and so I'm wondering about like that process, I guess.
Question. I just went through this myself because I'm at a relatively new job. I was like, what do I do with my old one? If you consider yourself someone who likes to be relatively hands off with your investing, I would say roll it all forward, which just means if your current employer offers a retirement plan, you can roll it into that one. And it's very simple to do it. So you can do it through, say, Fidelity, if that's your provider, Vanguard. There are portions of their website for this. And you can then just have one place to look at all of your money. The one caveat with that, I personally did not roll over my past account into my current one because my past account has access to funds at extremely low fees. Are the fee rates that different than my current one? No. But as a person who is like checking their account every week and I'm into it, it was worth it for me. But again, if you're like, that sounds really annoying, I don't want to do that, I think rolling over is a great thing. And generally, different providers offer quite diversified options. Like your past employer and your current employer probably offer, a broad US stock market fund, a broad bond fund, a broad international stock fund. So, from that regard, probably not so different.
Cool, thanks.
Mhm.
Michelle, I think you just have one more question in the chat. I don't know if you saw it. Can a self-employed person or small business set up an HSA?
I said, I don't totally know the answer. So I know you need a high deductible health plan. That's a requirement. In terms of it needing to come from an employer, I don't know the specifics, but I'll do research on that and send Lizzie the response, who will then share it with the group. What defines high deductible? So there are different deductibles depending on the plan you are on. So it's all sort of based on what your employer provides. And so employers typically have a couple health plans that employees can choose from. And so the high deductible health plan will have the highest deductible out of the three or the four or the two that are offered. That said, what that number is totally depends on the specific health plan. It could be $2,000, $5,000, 10,000, that number moves. But one of the points of an HSA is if you have a high deductible, you can use the money in your HSA to help meet that deductible. So it's less painful to have that kind of deductible. Okay, well, why don't we go to our final slide? And as I talk through it, if anyone starts to think about questions, just previewing that this will be the last slide. So slide 25 is our reflection slide and questions. So I want to end by saying this. And this is a theme throughout our 6 sessions, is that financial education is not reserved for anyone specific. I think everyone deserves understandable, practical financial information. And that's why I was interested in doing this class. And understanding investing is really important because it's a way that people build long-term financial stability. It's about reducing stress, building options, and really creating more freedom over time. So I am a big proponent of every small step matters and consistency. And it's really not all that glamorous or sophisticated at the end of the day. It's really putting small amounts of money aside over long periods of time can have really powerful benefits. So I want to end here, maybe pose a couple questions to the group that you can share vocally what you think. You can just think about it in your head. You cannot think about it at all. But is there anything that surprised you tonight? Something you learned that hopefully feels clearer. Um, Maybe things you're like, wait, this thing is not clear. Can we talk about that? And then a small next step that feels realistic. So I'll pause there and open it up to the floor. If anyone wants to share.
Yeah, I'll start. First of all, Michelle, thank you so much for doing this series. It's been incredibly informative. And thank you to Lizzie and Whirl for hosting it. It's much needed in this community, so I really appreciate it. I think the things that I have come out with, well, just from this session, because honestly, in my mind, I've taken notes from the last sessions, but I'm not sure. But this session itself, the reiteration of the power of compound interest is huge, and dollar cost averaging, which in my mind just means making sure that you're putting money aside every month for retirement and having kind of a goal or idea for what you want to get to. Yeah, so thank you.
Thank you for sharing that. It makes me really happy that hopefully this was helpful to people. And compound interest it's really an amazing concept that at least took me several times of hearing to truly digest. And then I haven't really felt it in my life yet. I haven't been investing for long enough, but I'm really excited to feel it because in those outer years, it's quite powerful.
I just wanted to also say thank you so much for the recorded sessions before, because even though I did missed a couple here and there, I was able to go back and go through them, and I'm going to go through them again, just to like take some more notes. But it is helpful to, you know, catch up later and have access to to those slides. So are they going to be up for a while or?
Yeah, great question, Basha. So we have a section now on the Whirl website that is, it's just a page for our health topic recordings. We're not able to record all of the kind of health topic programs that we do, but particularly for these online ones, we do record and pop them up there. So I will share that link again in the follow-up email. And there's some good stuff in there.
All right, cool. Thank you again. This was really informative. And I guess the thing that surprised me, I didn't know about HSAs. I'm really excited to dig in and see what that's all about.
Well, thank you for.
Sorry.
Go ahead, Donna.
Oh, sorry. Okay. Yes, I wanted to thank you, Michelle and Lizzie as well. I do not have a money head. I'm a nurse. I'm all medical. I really, really, really wish I had, of course, like this years and years ago. I am in retirement in my 70s, and it's like, wow, I wish I had started a long time ago. I am working with two financial advisors from New York, and they're helping me because the money stuff, you know. But you have clarified a few things that I really thank you for. Um, yeah, it's it's a lot. I can't do it on my own for sure. But they put me in a more conservative IRA. I was in a very aggressive one that made me some money when I worked at the hospital. But then once I retired, they figured they put me in a conservative one. So, and in this past few weeks, which was very helpful, I didn't lose a whole lot of money. So that was a really good thing.
Yeah,
But I thank you. You've really clarified a few things, and I really do appreciate both of you. Thank you.
thank you.
Yeah, I also just wanted to say thank you. It's been so helpful. And just yeah, the HSAs are just sound so wonderful. So if our employer doesn't set it up, and if we don't have if we're not shopping on the marketplace where we see HSA options, there's no way I can just set one up on my own, right? Just confirming that.
I don't believe you can just set one up on your own, but I need to do more research on the specifics of getting one, if it's possible, not through an employer, because I don't know that answer, but I will do more research.
Oh, thank you, Michelle. Yeah, I mean, our benefits just came out, and some of the deductibles seem very high to me, but I don't see them offering an HSA. Um, and about the HSAs also, is it true that if you get to age 65 and you haven't used the money for medical expenses, you can access it for anything you want, and it just basically becomes a Roth account at that point?
Yeah, so I believe that is true. Let me look at some research that I put down. Yeah, so at a certain age, if it's 65, I don't know the exact age, but somewhere around the retirement age, you can withdraw money for non-medical purposes too, but then ordinary income taxes would be applied. But I would say a lot of things are medical expenses. And so being clear on what those are, like I personally Googled what is HSA eligible? And there were a lot of things that were eligible that I didn't necessarily think were eligible. So just get a sense for what those are and if you're spending money on any of those things, and then just keep receipts. So I see there are a couple questions in the chat. Let me scroll through. Okay, yes. You didn't talk about Schwab. What do you think about them? I think Schwab is good. I don't have personal experience with them, but I know that they have done away with their fee-based trade model. So it used to be you had to pay a certain amount per trade, like a couple dollars, and now they don't do that anymore. So that's a very good thing to see. And they, like Fidelity and Vanguard, have so many investment options and also a good user interface where you can see helpful graphs and stock prices over time. So I think Schwab is good. Let's. What about SoFi? So again, I don't have personal experience with SoFi. SoFi to me, and I could be wrong, is more of an automatic framework for investing. So what they advertise is you don't want to invest your brokerage account yourself, here we'll do it. So it's robo investing, robo being robot. Again, if you like to take a hands-off approach, I think it can be interesting. I don't know SoFi's fees, so I would definitely check what their fees are, because it is a computer doing your investing. It's not a person at SoFi, so you shouldn't be paying the fee that it would take to have a person. And then look at the long-term returns. If they stack up well relative to a straight index, that's cool. But if the plain index did better than SoFi, why invest in SoFi? So again, I don't know specifically about them. I think they're reputable, but I would always check what the fees are and then how the performance compares to just straight up index funds that you would be able to buy on a Schwab, a Vanguard, a Fidelity, because you never want to be paying more for either the same product or a lesser product. Okay, I think I'm caught up on the questions in the chat, but if I have missed any, please shout them out.
I think there was a question from Eleanor. Do you have a financial advisor? Do you have financial advisor suggestions? Or does that not matter if they're localish?
I don't have the best sense for local ones. Lizzie might have a better idea than I do. I would say it's usually less about the company that they're from and more so your specific financial advisor. So I wouldn't say, advisors from Fidelity are the best. They all have access to the same data when you're at a big company like that. And so ultimately, it's kind of like having a therapist shop around and see who sticks with you because everyone has a different financial framework. See how much work they do on you. Like, do they do the work to understand your financial picture? Because everyone's different. What are they offering you? How hands-on is it? How hands-on do you want it to be? Some people are like, go do it. And other people are like, no, keep me apprised. So I wouldn't say it's, certain financial advisor companies are better than others. It's really about the person, and don't be afraid to shop around. I think with this kind of thing, some people can be pushy and they are trying to sell you. So always keep that in mind and remember that you have agency in this and you are ultimately the customer. So who is providing the service and the products that feel best to you? And oh, yes, always ask how they're paid. Two very important things with this. There are typically two forms of fees. There are management fees and performance fees. Management fees are a straight percent of assets under management. So, say you have $50,000 with a financial advisor, they might take 1% of that 50,000, no matter how it does. Now, I'm not really a fan of that fee structure because they don't do well when you do well, and they're not punished when you don't do well. The much more effective fee structure, I think, to be aligned with your financial advisor is a performance fee. So these are typically a percentage of profits. Now, it might be harder to find this because, of course, a financial advisor will want a management fee to always be able to keep the lights on and have that stability. But if you can have a 100% performance fee, at least have both. If it's just a management fee, that doesn't feel aligned to me. And ultimately, I want them to win when you win and lose when you lose. I have 15 more minutes. I can stay on and answer questions, but if folks have asked all their questions and feel like, they want to wrap here, happy to give the time back. And I just want to thank you all for coming to this series. I've really enjoyed getting to know you all, talking about these things, and hopefully learning together.
And thank you so much for taking the time, Michele. We really appreciate it.
I've had a lot of fun.
Mhm.
I do have one more
Thank you,
thing.
Michele. You were wonderful.
Thank you.
One last
Yeah.
question going back to when you're choosing, obviously there's multiple places to put your money in terms of like you had a discussion about like there's the retirement savings, the investment, right, kind of savings, but then there's like your padded savings, and then you have your high yield. Like how do you split that when you don't have, you're saying like put aside $5, but
Yeah.
when you're even dealing with those small amounts, I mean, I'm not talking about $5, but let's say it's 100, like how do you decide where to split that money if
It's
you're
a
talking about
great, all of these numbers are going to be different for each person. So I wouldn't say there's any specific number that everyone should be following. I would say it's about order of priorities. And number one is having an emergency fund. And to me, an emergency fund is about 6 months of expenses. God forbid you lose your job, you can't work. To just have a cushion for 6 months.
Mhm.
And I would put that in a high yield savings account because you can't afford to lose that money. It should not be invested, but you should make a nice 3 to 4%. Why not?
Right.
So that's where I start. And if that is all one can do, that's fine. But then I think the next order of priorities is to think about retirement. And they don't have to be big numbers, But again, taking advantage of time and compound interest. I would say try to put some money away for retirement and do what we talked about before of figuring out what that number is and moving backwards and seeing what's the ideal amount you're putting away each month. You may or may not be able to hit that. Life is life. But I'd say that's priority number 2. And then priority number 3 is a brokerage account. So invest for investing's sake, where again, very powerful potentially because you have compound interest, but you're not getting the tax savings that you are on a retirement account. So I would say that's sort of next on the totem pole.
That's super helpful. That clears it up because there's so many
Yeah.
very
Yeah. So many things we should be doing. And it's like, well, you can't do everything all the time.
yeah. Thank you again.
Yeah.
Thank you.
And
I
what
have kind of a personal question where I have a retirement account with Schwab, which is why I asked about Schwab. And my father just died, and he had a retirement account with Fidelity and an investment account with Vanguard. And is there a way that I know with Fidelity, I can, and I'm also dealing with this estate. And so I have asked my siblings to open up Fidelity accounts, inherited IRA accounts, so that I'm not liable for all of the taxes on it, when I cash it in. But so should I put, I don't know what to do. Should I take everything from Schwab and should I just stick with Vanguard and take my share of what my father had in Vanguard, stay there, put my Schwab there, put my Fidelity there? What?
Yeah, it's tough and it gets more and more complex as life goes on. I would say Schwab, Vanguard, Fidelity at the end of the day are kind of the same in the products that they offer. And so if you're concerned about, one being significantly better than the other, should I move here? That to me is not something to be concerned about. They're all relatively similar. To me, the question is the logistics and making your life a little easier. And so if you have 3 at play, I would cut down to 2 or 1. And all of these platforms have the ability to do transfers, inherited IRAs. All of those things are possible on all of the platforms. So
Okay.
if you've been using Schwab and you know Schwab and you're like, yeah, I like it, I want to stick with it, just roll it all over to Schwab. And then if you're like, oh, with my siblings, they opened Fidelity, let's move to Fidelity, that's fine too. But I would recommend consolidating because it can get unwieldy quickly.
Right.
Good news is they all have the capability to consolidate.
Okay, wonderful. Thank you.
I just wanted to throw it out there because I just rolled over from one, like an old account that I had from an employer and moved it to Vanguard. And I was still confused because of paperwork and the whole situation. Like I had to actually call somebody and like talk to them, and it got a little bit hairy. And I'm not, just knowledgeable in like all the technical terms. And I went to ChatGPT and I just had it, like I scanned the documents and I said, help me fill this out. And it did. And it made it incredibly simple. So I just like advise and help, like please lean into these, incredible tools that
Oh,
I have
thank
right
you.
now because
Yeah,
it
we
would have,
never would have thought of that.
yeah, I did not understand half of it. And there was like, oh, make sure you don't check that box because, that's kind of like a little like weird trick about like, I don't know. It was just very specific to what I had to fill out and how to fill it out. And it worked. I got everything rolled over without a problem. So
Oh, thank you, Vasha.
yeah, you're welcome.
Great tip. I've used ChatGPT for filling out my taxes. I was like, I don't know that specific thing. And it was very helpful. So don't put in personal information in ChatGPT, but for things like what we're talking about. Very cool. I saw a question. Oh, where does house savings fit in the priorities for young people versus retirement savings? Great question, and comes back to balancing all of these different financial goals. And so I would say ideally we can hold both together and balance, and it's less so one versus the other. I wouldn't say it's super clean cut what the priorities are sort of on the totem pole, and it is relatively personal. I would say a couple things to keep in mind. The tax benefits in retirement accounts are really great. And so you do want to take advantage of those if you can. And also think about what you hope your life looks like in retirement and save for that goal. That said, saving for a house is no joke and is the largest purchase many of us ever make. Now, the way mortgage rates are today, some people may be thinking differently about buying property. Or they may think, I'm going to buy a house regardless because I need a place to live and it's a way to invest money as well. Property is another form of investing. So I wouldn't say it's clean cut. I would say think about your timelines, think about your goal retirement number, and ideally you're able to hold both. I would say it's probably better to do both sort of halfway than just choose one. I think buying a house and completely foregoing retirement is a very scary proposition. And then on the flip side, you have to live somewhere, and paying rent forever when you could potentially own property might make more sense for your specific situation. So it's not clean cut, but I would not forego retirement saving. Okay, well, it seems like there are no more questions in the chat, and I'm not seeing anyone unmuting. I'll ask one more time, any additional questions? And it looks like no. So I'll end it here, and thank you all so much for coming to today's session and our previous sessions. I've really enjoyed it all, and I feel like we've been able to accomplish a lot. So thank you.
Thank you so
Yay.
much.
Thank you,
Thank
Michelle.
you. Thank you, Michelle and Lizzie.
Thank you,
Bye.
Yeah,
everyone.
thanks, Lizzie.
Okay.
Good night, everybody.